Hi, can you guys hear me? I hope I'm audible. Okay, great. So today we'll just be covering like the basics of what futures and options are. We'll try to introduce you to like the basic topics and everything, and hopefully we can proceed from there. Just give me 1 second. Okay, so first off, what exactly are futures and options? So we won't really be getting into like the nitty-gritty theoretical bits because that you can learn online. You have Investopedia, you have Varsity, you have a ton of other resources. If you have any questions about the theory and everything, you can just ask people for it, right? That will give you a lot more detail than even what I remember. So why choose futures and options? The reason why we trade using futures and options and not the spot market is because of something that they give us called leverage. Okay. So with leverage, what you can basically do is having a small amount, you can buy a lot more, right? Very simple example. If, for example, if I have Reliance stock and if I own Reliance stock, Reliance is currently at 2000 and I own one share of Reliance. Now, if it goes up by 1 rupee tomorrow, I make 1 rupee. Why? Because I have to pay up the entire 2000 bucks to buy that one share, and whatever increase I make, it will be a direct increase of the stock price. Now, with futures and options, that slightly changes. So, what exactly are they? They are derivatives. These are basically derived using calculus from the underlying, but they have a relationship with the underlying, right? So, futures and options are built on top of the underlying or the cash market. The cash market is basically some place where you can give your cash and you can get shares. You can buy something, right? So one of the main things is with options, you have two basic types of options, calls and puts. And with futures, you just have one basic set, which is futures. You can buy them or sell them. It's the same thing with futures and options as well. Now, what's the difference between options and futures? I hope if there's any confusion, we'll have like a VC later on after the session, and then I'll try to clear it up because it's probably pretty muddled as of right now. So again, why do we choose futures and options? Because we get something called leverage. In the initial example, if I buy one share of Reliance, if it moves up by 1 rupee, I make 1 rupee. But in futures and options, you have different techniques where let's just assume I can put in 1000 rupees, right? And when Reliance moves up by 1 rupee, I can still make that 1 rupee, right? So again, what is the example? With the spot market, Reliance at 2000, if it moves up by $1, you make $1, but you have to put in the entire 2000 bucks. In futures and options, you don't have to put in the entire amount because it's something they give you called leverage. With leverage, I just have to put in 1000 rupees and they will give me that share. Okay. Now there are other various other terms and conditions. We'll get into them later. So these are what futures and options are used for. You use them either to speculate or trade, or you might just use them secondly for arbitrage purposes, or thirdly, you might just use it for hedging your portfolios, right? So you can basically insulate your portfolio from any movements using all of these instruments, which is extremely useful for a ton of people, right? If you have like a large enough portfolio and you don't want, if the market falls down by 20% tomorrow, you want to make sure that you still have the same amount left with you. You can probably invest a certain amount of money into futures and options. You could have shorted certain futures, you could have bought certain puts, and you could have ensured that the amount of money that you currently have in the markets is safe and it remains the same. Okay, so quick recap. Futures and options, why do we use them? These are derivatives. They depend on the underlying, but there are various factors which affect them all. And why do we use them? Because of something called leverage. Okay, now how are options different from futures? Before even getting into the Greeks and everything, futures are pretty simple to understand. Futures just give you one advantage, which is the fact that you don't have to put in the same amount of money. They give you leverage, right? That's it. So if I have a Reliance future with me, Reliance is at 2000, if it moves up by 1 rupee, right? to buy the Reliance future, I just need 1,000 rupees, right? Because that's the leverage they provide me. That's the margin they give me. That I just have to put in 1,000 rupees, which my broker will block off, and he will give me one lot of futures. Right? We'll get into what lots are and everything. We'll get into all of that later on. But just to give you an idea, so now with 1,000 bucks, I can make money or lose money in the stock market. Now, let's get into options and hopefully things get a little clearer from now. What are calls and what are puts? The easiest way to remember is when you buy a call, you are calling the market up. So calls, you're calling the market up. If the market goes up, you will make money, right? That's what a call is. And with puts, you are putting the market down. Putting the market down, if the market goes down, you will make a certain amount of money. This is what calls and puts are. Oh God, 1 second, please. Yeah, now you just don't have to buy calls and puts. You can sell them as well. And everything basically just inverses. To enter into a call option, let's just take an index. Now, what exactly is an index? An index is any group of stocks or something taken together, and they are just looked upon as one singular entity. So Nifty is basically India's 50 biggest companies combined into one pool. So as a very simple example, this is not really true, but it's just a simple example. Nifty's value can just add up the stock prices of all the 50 companies, and then whatever number you get, that can just be one lot. This is wrong. It's a different number, but just for the sake of simplicity, so you understand what that is. So this is what an index is, any collection of stocks. You also have Nifty Next 50. You also have various other things. You'll find the same indices in other markets like DJI and everything, right? So what are calls and puts exactly? When you buy a call option, you expect the markets to go up. But then when you sell the option, everything becomes inverse. When you sell a call option, you are betting on the markets going down. Right? So what's a call? You buy a call when you want the markets to go upwards. When you sell a call when you want the markets to go down. And puts, same thing. You buy a put when you want the markets to go down, and you sell a put when you want the markets to go up. Now, there are differences between all of these. And to buy a call option, somebody has to sell you that put option. So for example, let's just say somebody comes up and tells me, I believe that Nifty won't be below, let's say, 10,000 by next year. The problem in this scenario is there's a high probability of that working, but there probably won't be anybody on the other end who's willing to take that risk, that Nifty will actually fall below 10,000. So despite you wanting to sell that put, you might just not have anybody who's willing to buy that put because nobody else is willing to bet on the fact that Nifty will go below this price, below 10,000, extreme examples. So you need two parties entering into an agreement. One will buy the call option, the other will sell the call option, right? And there's something in call options called a premium. So call options derive their value from basically two different factors. One is the intrinsic value. The others are called extrinsic values. Intrinsic value is extremely simple. Like, what is the relationship of the current call option that I have with the underlying, right? So let's assume Nifty is currently at 173,50, sorry. And if I want to buy a call option, let's say I just want to buy 17400. Okay, so 17400 will have two different values. One will be the intrinsic value, the other will be the extrinsic value, right? So the intrinsic value is fairly easy to calculate. The intrinsic value is basically 50 because Nifty is currently at 17350, and the call option that we want to buy is 50 points below this. So its value could be 50 or something. But then you will find that the value of the option is not 50. It will be higher than that, right? Now that is due to something called extrinsic factors, which don't completely depend on the underlying, not in all situations, right? So here we are getting into something which we call the Greeks. Now the Greeks are the ones which influence what this extrinsic value is. There are 4 different Greeks and they all affect the options price. So what is an options price? The options price is its intrinsic value, basically its relationship to where the underlying is and whatever all these Greeks are doing. There are 4 different Greeks and they all have different functions. Okay. Now, I hope what calls and puts are clear. And I hope you can understand you can buy and sell both of them, right? There are various advantages and disadvantages, but that is not really relevant right now. Another thing that you have to keep in mind is that your options expire, right? Your options expire. What expire means is if the value of certain options will go to zero at a particular preset time period. So just for the sake of simplicity, let's just stick to the Indian markets. So in the Indian markets, we basically trade on two main indices called Nifty and Bank Nifty. That's what I exclusively trade. I don't really trade in stocks and everything. But again, it depends on your preference and what you're really good at. Uh, so with Nifty, with the Indian markets, all your expiries are on. You have weekly expiries. So your options expire at 3:30 p.m. on every Thursday, right? And the last Thursday of every month, that is when your monthly options expire. So you have different types of options. One is your weekly options. They expire every week. For the Indian market context, it expires on Thursday. And in the other case, you also have monthlies, and monthlies are again the same. So the monthly options will expire then. So you'll frequently come across, if you open your brokerage app and type in like 17300 call CE or PE, what you'll frequently find is a date attached to it. It could be 16th, which is today. The options expire today, which we had the 23rd, which will probably be the 23rd, then you'll have 30th. 30th won't be marked because that will be the monthly expiry, because that's the last Thursday of the December month, right? So you have weeklies and you have something called monthlies. And based on how close an option is to the expiry, the Greeks will behave differently as well. Okay. So finally, let's just start with the Greeks. You have four main Greeks: Gamma, Vega, and Rho. Now, delta is fairly, so these Greeks basically affect the premium, right? The premium is the intrinsic value that you get. So gamma, Vega, delta, theta, these are the four main options Greeks that we have, right? Now, delta is the Greek, which basically gives you the relationship between the underlying option. The delta for every single option will be different, right? Now, for call options, the delta will change between 0 and 1, right? So a delta of an option will be either 0 and 1. Now, this means that if I have a call option, with a delta of 1, when my stock or my index, if the Nifty moves up by 1 rupee, my option will move up by 1 rupee. So that's what a delta 1 means, right? Now, if my delta is 0.5, then if the index moves up by 1 rupee, my option will move up by 0.5. Okay, so 1 is basically your highest exposure, where every single movement in the stock price will really affect you. But then you can also go delta neutral. You can also go select those options. You'll have to combine different options, but then eventually get like a delta of 0, which basically means that it doesn't really matter which way the underlying moves, whether Nifty moves to 18,000 or 16,000 from its current position of 17350, and it won't affect your PNL at all. This is one of the ways in which hedge funds and prop funds, all of these guys operate in. They basically make money no matter whether the market goes up or down. They are basically just playing these Greeks, the other Greeks: delta, Vega, gamma, and rho. So the call options delta goes between 0 and 1. And for put options, it's the opposite, right? It's minus 1 and 0. So this is fairly obvious because when you have a put option, you're basically betting on the opposite. If the price goes up, right, you will lose money. So if the price of Nifty goes up by 1 rupee and you have an at the money option. So at the money options will usually have like a delta of 0.5, right? So roughly around this number. And so each time the index moves up by 1 rupee, you will probably, if your current option has a delta of 0.5, you will lose half a rupee, right? Because the delta is 0.5, but it's minus 0.5. So I hope things are clear so far. And within the money, you have in the money options and at the money options. Of course, with what these three mean. So at the money is basically, suppose Nifty is at 17300, okay, exactly here. At the money option is the current strike price that it's at. So 17300 becomes your at the money option strike. Okay, and anything And based on whether something is above it or below it, you will have in the money and out of the money. Okay, so I hope at the money options are clear. And at the money options are pretty simple in the fact that they usually have a delta of 0.5, so you have half a bit of change. And for out of the money, right? What out of the money means for options is anything above that price, because your underlying will have to reach that to actually have any intrinsic value. So 17,500 when Nifty is at 17,300 will be an out of the money call. Now this call, the further higher up you go, if you look at a 17,500 call, maybe you look at a 18,000 call, all of these, the further away you go, the delta will become closer to zero. So let's just understand this with an example. Nifty is currently at 17,300, and I buy a call option, which is at 18,000. Now 18,000 is just so far away that it doesn't really matter if Nifty moves up by 1 rupee. The chances of it reaching 18,000 has not changed. Whether it had moved at 1 rupee or no, the chances of it going to 18,000 from its current value of 17,300 is negligible. So the Greeks can be understood in a fairly practical manner as well. So for out the money options, why is the delta 0 or less than 0.5? It's because they aren't as sensitive to changes in the underlying, right? And in the same way, your in the money options, so in the money options when Nifty is at 17,300, could be 17,200, 100, 00, and you have the 50s and everything as well. Now, something extremely in the money, let's say I buy 16,000 calls, that might just have a delta of 1 or something close to 1, right? So this is the entire range of delta that you get. I hope delta is clear. Delta basically captures the underlying and the rate of change of the underlying. And it varies from 0 to 1 for calls, and for puts, it varies from -1 to 0, right? I hope you've understood what the moneyness of an option is, what at the money is, what in the money and out of the money is for calls. For puts, is the exact opposite, right? So let's just assume 17,300 is where we're currently at. And your puts, 17,000 will be out of the money puts for you, right? Because the market has to go there. The markets have to actually fall down, and then they will have some intrinsic value. And your in the monies will be anything above that current price. So it's the exact opposite. So when Nifty is at 17,300, 18,000 will actually be out of the money for calls and in the money for puts. So the 18,000 strike when Nifty is at 17,300, yeah, this will be out the money for calls and in the money for puts. So I hope so far this has made sense. And this is just what delta is. Guys, I'm getting calls from people in the server. Please don't call me. Midcam, MITKAM, PGK. I mean, please don't. It's disturbing the entire thing. Okay, let's just move on to like the second Greek that we want to talk about, which is gamma. Now, gamma is basically related to delta. Now, as we already explained, you guys know by now what ATMs and ITMs are. And you know that for ATM options, your delta will usually be 0.5, right? And for in the money options, the delta will be close to 1. Your other money options have a delta of close to 0. So as we can see from here, as Nifty moves, the delta moves as well. So don't be under the assumption that delta or these Greeks have fixed values. The delta will change. So simple example. Let's suppose Nifty is currently at 17,300 and I buy a 17,300 call, right? It currently has a delta of 0.5. Now assume Nifty shoots up and touches 18,000. Do you think my delta still remains 0.5? No, now my option, which was originally at the money, has now become in the money. So its delta will go up from 0.5 all the way to 1 because it is now deep in the money. So deep in the money is just a fancy term of saying very in the money. You know, when you look at the option chain, it becomes fairly easy to understand. And how fast this delta will move, how fast will my 0.5 go to 1, that change is described by gamma. So that's all that gamma is. And it basically, one way of explaining it is if delta is speed, gamma is another derivative on top. So gamma is acceleration. So gamma basically tells you the rate of change of delta. Delta can be the first order derivative and gamma can be the second order, right? So delta and gamma and these two, they have a clear connection. And gamma, as we know, so it also varies. So as the delta will move, I hope you understand how gamma is affecting your delta, right? So you will frequently hear various terms being thrown about, like, I'm short gamma, I'm long gamma, this, that, blah, blah. Hopefully you can just understand what gamma is. Hopefully you can just Google a few terms and understand where you're at instead of being completely blank. So gamma is nothing. It's just the rate of change of delta. And gamma is always positive because it will always positively influence which way the delta is moving. And what people mean when they say that they are long gamma, it's basically when you're buying options. And when people say they're short gamma, they're basically writing options. Writing options or selling options is the exact same thing. And yeah, so that's all about gamma, I think. You also have rho. So rho is, what's rho? Rho is basically the interest rate. So rho doesn't really change, and rho is not really something that we consider. And yeah, so let's just leave that alone. And we have Vega. So Vega is basically volatility. Now, Vega will affect your option in different ways. So for example, if you're buying options, if the implied volatility spikes, the value of your bought options will go up. And if Vega crashes, and if it's going downwards, then it will also affect whether you've bought or sold the options, right? So Vega is basically just volatility, how volatile a stock currently is. The best example is probably ITC. ITC is, as we all make memes, it's a stable coin. It just stays at 200 and doesn't move at all. So in this ideal scenario where ITC hasn't moved at all for 20 years, its volatility might just be zero, right? Now, all of a sudden, if you find like a huge spike, now let's just assume ITC goes in one day, it goes from 200 to 300, and then it goes to 100, and then back to 200. Now there's so much volatility. Now there's so much movement. And because of all of this movement, the value of all of your options will probably go up. Why? Because now the chances of your option actually hitting whatever strike price that you had has now significantly increased because the volatility is there. Okay, different example. A stock is at 200 and it doesn't really move, right? It hasn't moved for 20 years. What are the chances, what's the probability of the stock moving to 200 and 250 tomorrow? The chances of that are very, very low. So the premium or the intrinsic value or the Vega factor will be extremely low. Now, let's just take the exact same scenario, but an extremely volatile stock. This stock goes from 10 to 20, goes from 100 to 200 and 300 every single day. Now, what are the chances that this same stock will touch 250 tomorrow? The chances could be extremely high, right? So this is how Vega affects all of your volume, all of your option prices. And for India, you have India VIX, VIX, and you can just search for that on TradingView or whatever. And Vega will tell you how much the premium is changing when the volatility increases or decreases. So when India VIX goes up and down, your options price will also change. What Vega will tell you is how much will it change by. And for each option that you buy and sell, especially as a beginner, just make sure you understand, just make sure you find the breakdown. What's the breakdown of all my Greeks? Try to maybe figure it out. It can be a decent exercise. And hopefully with time, it just becomes second nature. And all options increase when your volatility increases. So this is, I mean, slightly off topic, but this is why it can be extremely bad to trade during events, right? So if Reliance is coming out with its results tomorrow or something, then because the volatility might just have gone up significantly over the past 24 hours, or over the past 24 hours, it might just go down suddenly. And whether you're buying or selling options, it can be extremely complicated. So which is why for most beginners, I also advise them to stay away from event days. So when a company is declaring its annual results or a quarterly result, or Shaktiman is doing something, so best to probably not trade because the movements will be extremely volatile, and your options might just behave extremely erratically because you might not have accounted for Vega and what it'll do to your option. And saving the best for last, we have Theta. So Theta is basically the time value. So the amount of time there's left in an option, the value of that option changes. So I hope you guys understood why the delta is different for ATM, ITM, and OTMs, and also why the gamma is different, right? Now, theta, what is the probability of a stock which is at 200, which is currently at 200 and it's fairly stable? It doesn't really matter, but let's just say there's a stock which is at 200 and it doesn't really move all that much. What is the probability that will go to 250 over the next day? The probability here is extremely small, right? So, very logical perspective, you can understand that the value of the theta here at the end might not be very high because nobody is willing to bet on this. However, what if I tell you there's a stable stock, again, it's trading at 200, what is the probability that it'll go to 250 over the next 100 years? So now the time value that I'm giving you is changing. And over the next 100 years, anything can happen. So the chances that this stock will go up tomorrow is almost nil. So my theta value of this option is almost nil, right? The stock's at 200. I want to go above 250. What is the probability tomorrow? Extremely low. Over the next 100 years, extremely high. So you will have a lot of theta value. And as I'm sure you understand, as you move closer and closer to your expiry date, as I mentioned in India, so this month we had an expiry today, we have an expiry on the 23rd, and the 30th will be when the monthly options they expire completely, right? So, for example, right now the options for December, for 30th December, the monthly options, they will hold a lot of theta value. And today, the options which expire today, they had extremely little theta value. So options, everything else. All the Greeks are important, but for me in particular, I think theta is the most important Greek, mainly because it can be fairly simple to play around with, and theta is something which just decays with time. Its graph is fairly simple. Every single day your option will lose money, right? Because now I had 100 years for this option to go to 250. Now I have 90 years. So obviously the value of that option will become lower because now I have less time. And as it comes closer and closer and closer, it will eventually be, suppose the stock didn't move for the next 100 years. Now again, I'm in the exact same scenario where the stock hasn't moved for 120 years now. It's at 200. What's the probability it will go to 250 over the next 24 hours? So my option, which I bought for 100 years later, which had a lot of theta, the theta has kept decaying over all of those 100 years and has now become zero. This is something which even beginner traders can take advantage of, which is why I always advise that most beginner traders should start off with option selling because it's just so much easier, and at least you have a certain edge. You know that the option will just lose value every single day. And so if you're selling options, theta will be at your side. When you're selling options, you want the price of that particular option to go all the way to zero, and theta will help that option along every single day by just moving it lower and lower. Okay, so another way to play theta would be, now the longer time frame, the monthlies, 30th December options, they will have a lot of theta. So assume you sell one of those options now. Every single day it will keep losing value or it will keep going lower to zero. So even if the price does move with you or against you, you have a decent chance of making money either way. So these are what the four Greeks are. I hope, I'm sure this is pretty all over the place. But if you have any doubts, we'll try to clear it up on VC. It's much easier for me over VC when you have specific doubts in mind. I hope you guys have understood what expiries are. Every expiry is when certain options will go to zero. And with futures, you also have expiries, and that is when they have to be settled. Okay, settlement is something else we can talk about. With options, you have two main types of options. You have American style options and you have European style options. In India, we have American style options. The difference between the two is with European style options, you can only, suppose I buy a call option in the European markets, I can only close my position on expiry day. right at expiry. That's it. I can't really do much. With the Indian markets and the US markets, with sorry, American style options, I can close my position whenever I want. So that's the big difference. Uh, there are still people calling me, man. And with futures, the same thing as well in India. You can exit your futures whenever you want. I hope you guys have understood what leverage is. With a small percentage or a fraction of the amount that you have, you can take a much larger position, right? So if I have, let's say, 2,000 rupees, I buy Reliance. If it moves up by $1, I made $1. Now let's just assume I'm trading in FNO, I'm trading in futures and options. I can put in my entire 2,000 bucks, but now when Reliance moves by just $1, I can actually make 2 rupees. The reason being, I can buy 2 lots. Okay, this is a good question again. What's a lot? So a lot is basically the minimum quantity of something you have to buy. So with for Nifty, your average lot size is 50. For every option or every future, you have to buy at least 50 shares. So 50 multiplied by 17350, which is where Nifty is currently at, that's the value. That's the minimum value. You can go up to 50, 100, 150 to wherever you want to. Right? But you can't buy uh, 25 shares or something, 25 bits. That's just not there. So you have to trade in lots and multiples of lots. And again, leverage is the amount of money you actually have to put up. So Nifty's lot size is 50, 50 into 17350. That is a large number. But when you buy a future, you don't really have to put up all of that money. One second, please. Hello? Any better now? Okay, great. So yeah, now that you understand what leverage is, it's very important that you understand what risk is as well, because you have in with investing, there's a very limited amount of chance that you will blow up your entire capital. With trading, it is extremely possible, since you don't really have to put up all of your money, and if 50 moves in a large manner, then you will lose quite a bit. So with coming back to option buying, you can buy calls and puts, and you can sell them as well. And with buying options, so the theoretical is fairly different from the practical. With when you're buying options, what you learn theoretically is you have limited loss, since the maximum amount of money you can use is the money you've already put up, right? So suppose I buy a call option 17400 right now for about $100, which is probably its current price, right? Since Nifty was at 17340 or something. So 17400 is probably at $100. And if I buy that option, if I buy that call option, I'm expecting it to go up above it. Now let's assume it doesn't. So in this case, what will happen is the maximum amount of money I can lose is 96 into 50. That's it. I can't lose any more money because that's all I get. So limited loss, and the amount of money I can theoretically make is unlimited. Nifty, by in this random theoretical example, it can go up to 30,000. So the amount of money I will make is insane. So there's limited loss, and there's an unlimited amount of money you can make. With selling options, again, it's the exact opposite.
your losses in this case is unlimited. Suppose I sell 17400, right? 17400 right now. If I sell it tomorrow, it's currently worth $100. What's the max amount of money I can make? When the option goes to zero, that's when I make my maximum amount of money, which is the entire $100, which is the entire premium, which is the entire value of the option. And on the other side, that's the maximum amount. The maximum amount I make is 100 into 50, but how much money can I lose? Nifty again can go up to 30,000 tomorrow, and I can lose an unlimited amount of money. However, in real life, it is completely different. Since, as we've discussed the Greeks, you understand what theta is. So you can basically correlate that to the fact that with option buying, you are losing money every single day because theta will keep taking away certain value. Whereas with option selling, you're making money every single day, right? So the probability of profit when you're selling options is usually much higher, right? And the other thing is, in order to avoid this unlimited loss scenario, even when you're selling options, again, I'm an option seller. I mainly just sell options since at least I have a certain advantage. Uh, the best way to do so for beginners is to avoid the unlimited loss scenario because, again, risk management, right? You don't want to blow your account. The thing about trading is it is fairly difficult. It does take time, as we discussed yesterday. It does take years, at least a couple of years. I don't know if anybody who's made money with the first couple of years or anything. And to avoid this unlimited loss scenario, you can basically just hedge, which is something that we'll get into slightly more detail. So when you hedge, you are basically buying up another option and you are limiting your max loss. So let's just explain hedging with a very simple detail. So currently, or you know what, I'll just tell you what trades I took today, and then I'll basically try to explain using just that. So 2 days ago, I had a view that Nifty might just start going upwards. So I sold 17200 puts. Now, what's a put? Put is putting the market down. So I expected Nifty to go down, but I sold the option. So it becomes the opposite, right? So I'm pulling the markets up. So despite me having a put option, I'm long because I've sold that option. Selling that option or writing that option is the exact same thing, right? And my entire thing was, okay, it's currently worth $100, and I expect the markets to close above 172,200. And I had a decent break even as well because when you buy the option at $100, you have a different break even. It's not 17200 for me for break even; it's 17100. So I had that bit of cushion as well because of the way the selling works. With selling, you always have a slight edge. And so yesterday the markets were pretty zigzaggy, but they didn't really break through completely. And today morning, the markets went upwards and closed at 17340. I had this week's expiry. So by this time, my 17200 puts, they were worth nothing. They went to zero, right? Because did the markets close below that point? No. So what is the value there? None. The intrinsic value is obviously zero, and the extrinsic value is obviously zero now as well, because it has lost all of its value, all of the Greeks are now done. So I was able to pocket that $100. Now 100 into 50, that's the amount of money I made, right? So around $5,000 on a 3-day trade. And what I did for myself was I set the stop loss at around 2 p.m., 2 to 30 p.m. or something of that sort. And this is when I decided to sell that option as well. Why? Because I didn't expect Nifty to close below 250. And I thought that 50-point cushion that I'm getting, that 40-point cushion I'm getting, that's fairly reasonable as well. And luckily, Nifty moved upwards. 250 also closed at zero. And I was able to pocket that 40 rupees as well. Okay, so this is basically how option selling and everything works. Uh, I'll go through a mentorship chat right now. If you guys have any doubts or something, I'll try to clear them. Maybe later on we can do a VC. Let me just check the chat. Okay, so I don't think we really have any doubts right now. We can probably just, yeah, you're going to have more detailed classes on hedging and everything. This session is just to introduce certain topics, and everything else is done. Yeah, but I squared it off at 0 point something something. I mean, I didn't square it off, I just left them. Because with indices, your your entire options are cash settled. So I don't have any problem with getting exercise. You can't get exercise, which is an issue if you're selling options and stocks, which is one of the reasons why I avoid them. So I just left my position. It's easy. And I didn't square it off. Didn't have to. They both went to zero. So
But if you have any questions, you can ask me. Please.
Uh, Hello. Am I audible? Hello.
Yes, yes, you're audible. You're audible.
Okay, so I had a doubt that someone asked previously in the chat also. So, like, how do we decide whether we have to sell or like buy a call? Because both means that we are bullish, right? Like, if we're selling a put, sorry, and we are buying a call, wouldn't they be the exact same?
Nahi. Okay, so I guess this is all we can talk today. In the next class, we'll get into option strats, and then hopefully you can understand a lot more. This introduction bit is pretty complicated, man, because I myself am not really completely sure about the theory, and I'm pretty sure I messed up in a couple of places. This is not something I uh, currently have to think about. I don't really have to think about what the Greeks are much. So if you guys have any doubts later on, then you can always let me know, and we'll try to clear them up.
Sure,
So
sure.
I guess this is all for today. Thanks.
Okay. So to answer your question, selling always has an edge, right? So like he said, the previous example, he said Nifty is at 17,300 and he sold 17,200. So when you sell an option, you break even. If you sell that option at 100 rupees premium, your break even is 17,100. So so I understand that you are very strongly bullish, but there is a probability that you are wrong. So no one is perfect, no one can get things right all the time. So sell. But the problem is when you sell, you need to put up all the margin, right? So margin is very high in these cases. I think for Nifty, it's about 1 lakh per lot or something. I don't know, but yeah. So it all comes down to whether you have that much capital to sell. First of all, if you have, then the second thing is how much confident are you with your call? If you're really, really confident ki yes, I am bullish and this will go up, you can buy, because in buying what happens is max loss is defined but max profit is infinite. So if your call goes well, there's a probability that you make a lot of money. But in selling, that 100 rupees is the maximum you can make, and if your call goes wrong, you lose money, but there is a less probability that your